In one of our previous videos, we talked about the 3 stages of a buying decision. The first one being awareness, where you've got to get the attention and get investors' attention for your business. The second stage is a consideration phase when people are deciding whether to invest or not. And then the third stage is obviously the decision-making stage. Now, the part I want to delve on this one is awareness. So this is the first stage. So what's really important about the awareness stage is that effectively, what we have to do as founders is we have to help our business go from being unknown to known in the minds of potential investors. So one of the ways that we can actually do that sometimes could actually be through our own social media channels, whether it be LinkedIn, whether it be Twitter, whether it be Facebook, whatever's relevant for you in your sort of area, then creating awareness could actually be quite useful across those social media networks. Now, the other part is could be startup media networks, traditional media networks, platforms. There's all sorts of different ways to get awareness. Otherwise, virtual pitch days, showcases, all that sort of stuff. The idea is that how do you go from being unknown to certain communities to being known? That could be relevant to investing into your business. Now, when you're going and presenting to those ecosystems, effectively, you got to think about it is that investors are being conditioned to look for certain things in opportunities. Now, what will happen is most people will just focus on traction, right? But what we've identified is there's 7 key areas that are important for investors when they're looking at an opportunity that basically draws them into at least say, I am interested to know more. Now, that is effectively all you are going for at the awareness stage is to have an investor say, that's interesting, I want to know more. And the only way that we can do that as founders is if we can actually demonstrate trust and confidence indicators in our actual business, right? Now, sometimes those trust and confidence indicators could be the traction metrics. That is one way of doing it. The other one could be our existing investors, right? If our existing investors are well known in a space, that can make a difference for potential investors, right? Another area that we could look at is the actual sector that we're in. Now, sometimes when a sector's been buoyed or a sector's on fire and the growth rate is going through the roof, sometimes that alone really lifts up the confidence that an investor has because they like to invest in momentum opportunities, right? So this is all very, very commonplace. Now, the other part is that if you're a B2B business or you're an enterprise business, then having blue chip customers or blue chip trials is another important way of actually that sort of getting interest, because what that means for the investor is that a large company has run through a procurement process and they have still decided to purchase your product, right? So it's basically showing product market fit amongst obviously blue chip clients. And most people are quite well aware of the sales cycle that goes with larger companies. So these factors are all important when you're going through that awareness phase. Now, one of the things that's really hard for us to do as founders is to not rush the investor stage. Most people, when they're thinking about their capital raise, they want to go, as I said, straight from awareness to decision. What's really powerful about spending time in this awareness stage is that, and I give one of the principles we work towards is always be raising, is that you can constantly be driving people into your deal room and having conversations, right? So what this does is this helps you get a gauge and get a feeling for when is the right time to actually raise capital. So if you think about the strategy that a lot of companies are working towards now, where they're raising, where they are raising either larger amounts of money to go for a longer run cycle, or what they're doing is they're raising smaller amounts of money and then really just hitting milestones along the way to keep on building up their progress, keep up building up their milestone, and keep on working towards that sort of larger capital raise. That is another way of actually doing it, right? So whatever your strategy is, the awareness stage is super important because it allows you to go from unknown to known with the types of investors that you're looking to attract for your business. So key principle is the first stage of the buying process is awareness. Don't rush this process. Spend time in this process. Spend time building awareness for your business, right? And don't leave your capital raising to the last minute, because you want to spend this time in this area to attract the right investors to participate at the right time. And then what that does is that helps you understand, because when you get to the stage where you've got sort of 20 to 30 investors into your deal room, you know that this is the time for you to open up your capital raise. So I hope that was helpful. First stage of the buying decision is an awareness stage. You were looking for what are the trust and confidence factors that can have an investor say, That's interesting. I want to know more. Hope that was helpful. Look forward to providing the second and also the third stages.